Welcome to Manager's Edu. Today I will teach you payback period and discounted payback period. This is a continuation of our series on capital budgeting techniques. Payback period is the time required to recover an investment's cost. Let's understand it conceptually with an example. Payback period is one of the important techniques in capital budgeting. We will understand it with the same simple example we used in the NPV and IRR videos. For example, I am investing $1,000 in a project that will continue for 5 years. The project is Bitcoin mining. For the first year, it gives me $300 of return. For the second year, it gives me $400. Third year, $450. Fourth year, $350. And for the fifth and final year, $370. Now, let's calculate the cumulative cash flow at the end of each year. At the end of year 1, we have $300. At the end of year 2, we have 300 plus 400 equals $700. At the end of year 3, we have 700 plus 450 equals $1,150. So, our initial investment of $1,000 lies between year 2 and year 3. This means our recovery will happen somewhere between year 2 and year 3. The formula for payback period is payback period equals last year with cumulative cash flow less than initial investment plus uncovered amount divided by cash flow of the next year. In our example, the last year where cumulative cash flow is less than $1,000 is year 2. The uncovered amount is $1,000 minus $700 equals $300. The cash flow in the next year, year 3, is $450. So, 300 divided by 450 equals approximately 0.67. Then, year 2 plus 0.67 equals 2.67 years. If we multiply 0.67 by 12 months, we get approximately 8 months. So we can say the payback period is 2 years and 8 months. This means the initial investment can be recovered in 2 years and 8 months. Since the project lasts for 5 years, our recovery happens earlier than the project's end. After 32 months, we start making profit. I hope this clears your concept. Now, let's understand discounted payback period. According to the previous example, a financial manager will consider inflation, earning potential, and risk factor. If inflation is 3%, earning potential is 5%, and risk factor is 2%, then our discount rate becomes 10%. So we will discount each year's cash flow at 10%. First, we create a table with columns for year, cash flow, discount factor at 10%, and present value of future cash flow. Then put the data for first year, second year, and so on until the 5th year. Then write all cash flows. Then take the value of the discount factor after calculation. Then we multiply each cash flow by the discount factor to get the discounted cash flow. For year 1, $300 divided by 1.10 equals approximately $273. Year 2, $400 divided by 1.10 squared equals approximately $331, and all are calculated the same way. Now we calculate the cumulative discounted cash flow. After year 1, $273. After year 2, 273 plus 338 equals $942. After year 3, 942 plus 239 equals $1,181. Our initial investment of $1,000 lies between year 3 and year 4. Now put the data in the formula to calculate the proper payback period. The cumulative discounted cash flow after year 3, the uncovered amount, is $1,000 minus $942 equals $58. The discounted cash flow in year 4 is $239. So 58 divided by 239 equals approximately 0.24. Then year 3 plus 0.24 equals 3.24 years. Multiply 3.24 by 12 months gives approximately 3 years and 3 months. So the discounted payback period is 3 years and 3 months. Now let's compare payback period and discounted payback period. Without discounting, the payback period was 2 years and 8 months. With discounting, the discounted payback period is 3 years and 3 months. Why the difference? Because we applied a 10% discount rate each year to account for inflation, earning potential, and risk. This makes the future cash flows worth less in today's money, so it takes longer to recover the investment. For a company, the earlier the payback period, the better. If the payback period comes before the project ends, it is quite good. The earlier it is, the more beneficial. I hope you understood this. If you have any questions, please comment below. Now, subscribe to our channel. Thanks for watching.